Welcome back. You're still watching Smart Money on CNBC-TV18. Today we're here to talk about your taxes and how you should be filing your taxes before the 31st March deadline. Mrin, Agarwal and Sujit Bangar are with us. I want to ask this question to Mrin. Mrin, what are the documents and the proof that I have to submit before the 31st of March in order to make sure that my taxes are filed in a proper way?
Yeah, so of course, this is relating to proof submission to the employer. So first and foremost, you need to have all your Section 80C investment documents in order. And one thing that I think everybody should remember, that if you are planning to invest in the ELSS, the date of credit is the one that counts. And with all the bank holidays that are coming up next week, especially from 29th onwards, be mindful of that. I do see a lot of people trying to do it the last day. So, be careful about that. So, of course, you need to provide a proof of all your investments. You need to provide a proof of insurance premium paid. And always remember that it is insurance premium paid for self and dependent family members. Again, Section 80D on health insurance premium, if you are claiming it, then you do need to provide the premium paid receipt. And again, remember, because I do see a lot of people including in-laws in their health plan as well, but what premium you paid for in-laws is not included. It's only dependent parents and children and self. Loans, education loan, which comes under Section 80E, and home loan, of course, which comes under Section 24. And mind you, all of these come only under the old tax regime and not in the new tax regime. So your interest certificate in case of the loans as well. Rent receipts, if you're claiming HRA, and remember, you need to have the PAN details of the landlord if the rent is above 1 lakh. And travel proof for LTA, other allowances. And if you've made any donations, you need to provide the receipt. So I think the main thing to remember is that all these documents have to be in order, and they need to be correct in all aspects.
Okay, got it. Sujit, what about you? What are the things that I need to be mindful of before I file my taxes?
See, one important aspect which will add to what she has very elaboratively explained about the documents. If you have changed your job, you need to be very careful in this month, because there are two scenarios. First is that your earlier employer might have done lesser TDS compared to your earlier employer's income. Then you have to inform your current employer about that thing. And if suppose you don't inform, then you end up into paying more tax when the return of income has to be filed and the interest outgo will be more. And similarly, there will be case if your earlier employer has made more TDS than your commensurate income, then you have to inform your current employer about that, so that current employer will reduce the TDS portion, because already tax has been deducted at some higher level by your earlier employer. This will ensure that unnecessary I did not go for claiming refund and my taxes will match with my income. So this, if there are more than one employer, this care has to be done, and one has to submit that 12B is the form, has to be submitted to the employer, giving these details of the earlier employer and income and tax collected at source.
Okay, that's interesting. Mrin, you want to comment on that? We never talked about that. If people, because nowadays a lot of young people are switching jobs very quickly. So if that happens, what are the things that I need to be mindful of?
Yeah, so I think Sujit explained it, that you need to declare all whatever taxes have already been deducted, and through that form 12B very clearly. Sometimes I think I do see people tend to forget giving that form in time, and if that happens, then you're going to have extra TDS getting deducted. Of course, you can claim it back at the time of ITR filing, but there is going to be this gap. So I think more and more, I would say, the focus is on really ensuring that, you're very mindful about the finer details of things, because they do matter a lot as far as taxation is concerned.
Okay, got it. Sujit, another question that I had for you is how to plan my taxes on capital gains on the sale of listed shares. How to time the booking of long-term capital gains on listed shares and equity mutual fund schemes up to 1 lakh. It's an important question because a large part of our audience are equity investors.
A very valid question, Sonia, and good that you asked this question, because see, in capital gain tax planning, I always consider March and April are very crucial months, because if you use March and April innovatively, then you can reduce your taxes substantially. So in capital gain, there are two ways to save the tax. First is that deferred, you can do your sale of equity in a deferred way. For example, if I have 2,50,000 is the gain which come to me if I sell shares of some XYZ company, then now it is last week of March. So what I can do is that I can sell the shares in such a way that before 31st March, my gain will be up to 1 lakh, and the remaining sale I will do in the first week of April. So if we plan it accordingly, then almost nil tax or negligible tax I have to pay, because as it is, we know in long-term capital gain up to 1 lakh gain is exempt from taxation. So this is a deferred way of selling. By way, if we plan it innovatively in March and April, then we can certainly save taxes. And as it is, period is of 2 to 3 weeks, so rate fluctuation hopefully won't be there much in case of the rate means the scrip price. Second way of saving tax important is of tax loss harvesting. The tax loss harvesting is very technical jargon, it seems, but it's very simple. Suppose in the March, I know how much I have gained from my shares. It is already with me. And suppose there is one scrip where I'm thinking of keeping that scrip for a long term, but I think that if I sell it today, some loss will come. So I should book the loss, and I will set up that loss against the gain which I am getting in the current year. So what will happen? So my tax, otherwise my tax outgo which was going, which will for that gain which I had got, it can be reduced by that loss to that extent. So this way proper, and again I can buy that shares in the after 1st April. So if I plan it accordingly, then the loss, the tax on the gain for the current year can be reduced by this loss planning. So these two things are important. One should look at it, but execution has to be very with a precision. So certain mistakes should not happen, because otherwise it's very costly.
Okay, Mrin, any final thoughts? Because there's such a large audience that does their capital gains tax planning as well. Any final thoughts for them?
Yeah, I think, as I said, calculate that income correctly and match it with the AIS. That's point number one. The second bit on the investments, people do tend to invest very randomly and in a hurry. So don't, do that, because many times you're getting into, products where you're making a multi-year commitment. And, so of course, think about it carefully. What sort of a product do you really want to invest into? Of course, it's really important that when you're investing for ATC, look at products that tie in with your financial goals, because that way you're basically investing for your financial goals and at the same time you're saving tax. And finally, I think, as we've talked through the show, that it's really important to focus on the documentation and the proofs and ensure that you maintain these correctly as well.
All right. With that, we will wrap up with this edition of Smart Money. Thanks a lot for joining in and helping us understand how to plan your taxes, what all to do before the 31st of March. Hope this was helpful. Keep watching CNBC TV 18 for more.